Good day, ladies and gentlemen. I'll be discussing the topic depreciation. I'll first define what depreciation is, then go to the how, what, when, and why do we depreciate an asset. Depreciation is a systematic allocation of the depreciable amount of an asset over the estimated useful life of the asset to reflect the pattern in which income is generated through the use of an asset. I've mentioned a lot of new terms or terms that you're not familiar with, so I'll break them down for you. Depreciable amount, cost less residual value. This represents the amount on which depreciation will be calculated. At the end of the useful life, the value of the asset should equal the residual value. Residual value is the estimated amount that the asset will be worth at the end of the useful life. It is estimated when the asset is ready for use. Useful life. Estimated period of time that the asset will be used by the entity or the number of production units expected from the use of an asset when the entity is using production unit method, and this is estimated when the asset is ready for use. What can be depreciated? Tangible assets, namely vehicles, buildings, and machinery. When can assets be depreciated? It's allowed when it is ready for use and not necessarily when it's bought, and you account for it at the end of the financial year. When an asset is idle, you can continue depreciating the asset with the exception of production unit method. It is not allowed to depreciate an asset when it is scrapped or sold. Depreciation is used to account for the usage of an asset. It is recognized as an expense. It can be depreciated if the asset has unlimited useful life, e.g. land. It leads to a decrease in equity. This expense is debited in the general journal and in the general ledger. Then it is closed off in the profit or loss account. The contra account of depreciation is accumulated depreciation, which accounts for all the depreciation over the years. How do you account for depreciation? There are various methods, namely diminishing balance, production unit, straight line method. I'll be focusing on the straight line method. And with the straight line method, you use the same amount of depreciation that gets allocated every year over the useful life of the asset. There are two different formulas you can use to calculate the straight line. One, it's cost minus residual value times the depreciation rate which will be given times the number of months the asset was ready for use in the financial year divided by 12. Or if you're not given the depreciation rate, then you say cost minus residual value divided by the useful life times the number of months an asset was available for use in the financial year divided by 12. Then now we'll move to our example. A vehicle was bought on the 1st of January 2020 for 500,000. It was ready for use on the same date. The financial year is on January to 31st December 2020. The depreciation rate is 25% and the residual value is 100,000. You can do this with me. 500,000 minus 100,000 times 25% times 12 over 12 gives you 100,000. So it's cost minus our residual value that was given times depreciation rate that was given times it was ready for use for the 12 months in the year over the 12. Then you get the 100,000. Earlier I mentioned that our residual value equals to the value of the asset at the end of the useful life. So we can use this example to test if that's true. Then that's why I written 4 years later, which is the 100,000, the annual fee, the annual depreciation amount times 4 years is equals to 400,000. Then you have to say cost minus accumulated depreciation, which will equal to residual value. Then I have 500,000 minus 400,000 equals to 100,000, which is the same as the given residual value. Thank you.